Did you know that Warren Buffett, the world's most famous investor, made his first investment when he was just 11 years old? Fast forward to today, and his net worth is over $100 billion. That's more than some countries' GDPs. But here's the shocking part. Buffett didn't get rich by chasing after the next big trend or gambling on hot stocks. He built his wealth by following a few simple rules that anyone can learn, and that's exactly what we're going to explore in this video. Buffett's investment strategy isn't about complex formulas or risky moves. It's about common sense, patience, and a long-term mindset. He says, the stock market is a device for transferring money from the impatient to the patient. In other words, slow and steady wins the race. In this video, we'll break down 6 simple but powerful rules that have helped Buffett become one of the wealthiest people in the world. Whether you're just starting out or looking to sharpen your investing skills, this guide will give you the tools to think like Buffett and start building your financial future. Ready to learn the rules that could change your life? Let's dive in. Chapter 1. Buffett's Blueprint. The secret to long-term wealth. Warren Buffett is one of the wealthiest people in the world, but his secret is simple: value investing. Buffett's strategy is all about buying high-quality businesses at a fair price and holding onto them for the long term. Unlike most traders who focus on short-term market movements, Buffett believes that investing should be about buying companies you truly believe in. One of his famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This long-term mindset is key. For instance, Buffett's stake in Coca-Cola has made him billions over the years. But he didn't buy it for a quick profit. Instead, he saw Coca-Cola as a brand with strong, lasting value. When you focus on the business itself, not just the stock price, you're investing in something more reliable. A great example of this is Buffett's decision to buy See's Candies. He didn't just buy chocolate factories, he bought a beloved brand with loyal customers and consistent demand. Over time, the profits grew, showing how powerful patience and consistency can be. According to Buffett, the stock market is a device for transferring money from the impatient to the patient. In short, Buffett's blueprint is straightforward. You need to focus on businesses that you believe in for the long term and that have a competitive advantage. That's the foundation of his strategy, and it's the key to understanding how he has created such massive wealth. Chapter 2. The Power of Patience. Why time is your best friend. Warren Buffett's success isn't just about picking the right stocks. It's about having the patience to let those investments grow. One of the most important lessons Buffett teaches is that time is your best friend. Our favorite holding period is forever, he once said. He isn't in a rush to make money, he lets the magic of compounding do its work. Buffett often points to compound interest as one of the greatest forces in the world. Think about this. If you invested $1,000 and earned a return of 10% annually, that investment would grow to $2,000 in just 7 years. Over 30 years, that same $1,000 investment would be worth over $17,000. But only if you let it grow steadily, year after year. That's why Buffett doesn't care much about short-term market fluctuations. Stock prices can go up and down in the short run, but businesses that generate consistent profits will continue to grow in the long run. The longer you hold onto your investments, the more likely you are to see those returns compound. It's easy to get distracted by the daily ups and downs of the market. But remember, Buffett sees these fluctuations as opportunities, not threats. He once said, "Be fearful when others are greedy and greedy when others are fearful." This simply means that when the market is down and people are panicking, it's often a great time to buy good companies at a discount. Patience doesn't mean doing nothing, though. It means being ready for the long haul and not being shaken by every piece of bad news. Over time, those small decisions add up, and your wealth will grow quietly and steadily. Chapter 3. Buying businesses, not stocks. Buffett's hidden secret. One of the most unique aspects of Buffett's strategy is how he thinks about investing. While many investors focus on buying stocks, Buffett focuses on buying entire businesses. When he buys a stock, he doesn't just see it as a ticker symbol. He sees it as part of a real, functioning company. Buffett often says that if you wouldn't want to own a business for 10 years, you shouldn't buy the stock for 10 minutes. This idea completely changes the way you look at investments. Instead of trying to time the market or jump in and out of trades, Buffett teaches us to think long-term and buy businesses that we understand. Take his investment in American Express, for example. In the 1960s, American Express was struggling with a scandal. But Buffett saw beyond the short-term trouble. He understood the company's brand power, its customer loyalty, and its potential for growth. That's why he decided to buy into it when others were scared. Over time, his investment paid off handsomely. Buffett also focuses on businesses with strong, consistent earnings. Companies that have a moat around them, meaning they have a competitive advantage that protects them from competitors, are key to his strategy. Think of Coca-Cola with its brand strength or Apple with its loyal customer base. These companies have the ability to generate profits year after year. The important thing here is that Buffett doesn't chase trends or gamble on speculative companies. He looks for businesses that have stood the test of time and are likely to continue doing well in the future. When he buys a business, he's in it for the long haul. As he says, the most important quality for an investor is temperament, not intellect. By focusing on businesses instead of stocks, Buffett eliminates a lot of the uncertainty that comes with short-term market movements. He's not looking for the next hot stock. He's looking for reliable companies that will grow over time. This strategy has made him one of the most successful investors in history, and it's a great lesson for anyone looking to get started in value investing. Don't forget to subscribe and hit the bell icon to get more tips on investing like a pro. Chapter 4. Margin of Safety. Why risk isn't always obvious. One of the most crucial concepts in Warren Buffett's investment strategy is the margin of safety. Essentially, it means buying stocks at a price lower than their true value, giving you a buffer in case things don't go as planned. It's about reducing risk. Buffett often says, the most important thing to do if you find yourself in a hole is stop digging. The margin of safety isn't just about buying at a discount. It's about being cautious and avoiding overpaying for investments. If you buy a business that's worth $100 for $80, even if the business faces some setbacks, you're still ahead because you have a built-in cushion. But if you pay $100 for a business worth $80, you're exposed to more risk. This idea comes from Benjamin Graham, Buffett's mentor. Graham introduced the concept in his book The Intelligent Investor, and Buffett has followed it ever since. In fact, Buffett often credits Graham's teachings for shaping his approach to investing. The margin of safety is particularly important in today's market, where stocks can be overpriced due to hype or speculative behavior. To put it into perspective, let's look at a real-world example. In the 2008 financial crisis, many great companies were available at a steep discount due to panic selling. Buffett took advantage of this by purchasing stakes in companies like Goldman Sachs and General Electric. He knew that, despite the short-term problems, these companies had solid fundamentals and were trading below their true value. By focusing on a margin of safety, Buffett ensures that even if the market doesn't perform as expected, he can still make a profit. The key takeaway here is, don't chase stocks based on excitement or trends. Instead, focus on undervalued companies with a margin of safety. This is the best way to minimize risk and maximize your long-term returns. Chapter 5. Circle of Competence. Investing within your expertise. Another powerful principle from Buffett's strategy is the circle of competence. This simply means investing in industries or companies that you understand. Buffett has famously said, "We don't invest in things we don't understand." While many investors try to branch out and invest in unfamiliar sectors, Buffett keeps his focus on businesses he knows inside and out. For example, he never invested in technology companies for a long time because he didn't understand them as well as industries like consumer goods or insurance. Instead, he stuck to businesses where he had a clear understanding of how they made money and their long-term prospects. The circle of competence is a great tool for beginners. It allows you to focus on companies or sectors where you already have knowledge or interest. Maybe you're interested in retail, technology, or healthcare. These are all areas where you can focus your energy. By staying within your circle, you're better equipped to make informed decisions and avoid costly mistakes. One interesting thing to note is that Buffett's circle of competence has expanded over the years. While he initially stayed away from tech, he eventually became an investor in companies like Apple. However, this wasn't a random move. Buffett understood Apple's business model, its brand loyalty, and its ability to generate cash flow. His investment wasn't about tech, it was about understanding a great business. The lesson here is clear: know your strengths and focus on them. You don't need to invest in every hot trend. Stick to what you know, and you'll be more successful in the long run. As Buffett says, the difference between successful people and really successful people is that really successful people say no to almost everything. Chapter 6. The Power of Simplicity. Keeping it simple to win big. Buffett is a big believer in simplicity. He avoids complex financial instruments, and he's never been interested in speculative bets. For Buffett, the key to successful investing is clarity and simplicity. He has often said, "You don't need to be a rocket scientist. Investing is not a complicated thing. You just need to be patient and sensible." Simplicity doesn't mean doing nothing, though. It means sticking to clear, understandable strategies that are easy to implement. For Buffett, that means investing in companies with strong fundamentals, a track record of success, and clear growth prospects. It's about finding quality businesses that you can hold for decades, not jumping in and out of volatile stocks. One example of Buffett's preference for simplicity is his decision to invest in companies with durable competitive advantages. These are businesses with strong brands, high customer loyalty, and solid pricing power, companies like Coca-Cola and American Express. The simplicity of these investments lies in their predictability and resilience over time. Buffett also avoids confusing financial jargon or complicated stock analysis. Instead, he focuses on the essential metrics that show a company's value. In his famous letters to shareholders, he often emphasizes the importance of understanding basic financials like revenue, profit margins, and return on equity. These simple metrics can tell you a lot about the long-term potential of a business. What's even more interesting is that Buffett's simplicity extends beyond just investing. In his personal life, he lives relatively modestly despite his wealth. He doesn't need a complex lifestyle to be happy, and that same mindset guides his approach to investing. The takeaway here is that investing doesn't need to be complicated to be successful. By sticking to straightforward, proven principles, you can make smart decisions and build long-term wealth. Buffett's success is a testament to the power of simplicity. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective, he once said. Buffett's approach to investing proves that keeping things simple doesn't mean missing out on big returns. It means focusing on the things that truly matter and avoiding unnecessary complexity. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon for more investment tips that will help you start building your wealth like Warren Buffett. Stay tuned for more.